Hi viewers, so in this video we'll do DEGNIS company question. So in previous video we have already covered BRT company. So let's first read out the requirement. Okay, the question have with the four requirement. The first is asked to calculate the expected NPV of a planned investment for the first 4 years of operation. After that, the question told after the fourth year of operation, DEGNIS company expect to continue to produce and sell 450 motorhomes per year for the foreseeable future. Calculate the effect on the expected NPV of the planned investment of continuing to produce and sell motorhomes beyond the first 4 years and comment on the financial acceptability of the planned investment. Critically discuss the use of probability analysis in incorporating risks into investment appraisal. And the last requirement, discuss the reason why investment finance may be limited even when a company has attractive investment opportunity available to it. Okay, for the first requirement, let's begin to read the question. DEGNIS company is a company that installs kitchen and bathroom to the customer specification. It is planning to invest 4 million. So it means this is our initial investment amount minus 4,000 and I have taken 30 common. Okay. In a new facility to convert van and truck into motorhomes. Okay, each motorhomes will be designed and built according to the customer requirement. DEGNIS company expect motorhome production sales in the first 4 years of operation to be as follow. So we have the life of the project which is 4 year. Okay, and sales unit and which is also a production unit. It's 250, 300, 450 and 450. The selling price for the motor homes depends on the van or truck which is converted, equality of the quantity installed and extent of the conversion work required. DEGNIS company has undertaken research into likely sales and cost of different kind of motor homes which could be selected by the customer as follow. So basically they have just decided the selling price as well as conversion cost based on the probability assigned to the type of selection by the customer. Okay, so now we have to calculate the expected NPV and conversion cost. So selling price per unit, in this case we will take the 30 common, so it means 30 into and assign the probability. Okay, 42 into 0.45 and last 72 into 0.35, right? Okay, it will be same over the year. Now conversion cost per unit mm, 23 into 0.2 plus 29 into 0.45 plus 40 into 35. Okay, so 31.65. Okay, so now fixed cost of the production facility are expected to depend on the volume of motor home production are as follow. So fixed cost. Okay, as the question has already taken the 30 common, so we don't have to take here. We will simply put the amount 4,000 as company is producing 250 in the first year and which will be lie in between this range, so 4,000. Okay, and the next 5,000 as 300 in these 300 unit is in between the range which has been given the question, 300 to 399 and just for 5500. Okay, okay, so now DEGNIS company pay corporation tax of 28% per year, with the tax liability being settled in the year in which it arrives. It means whatever the tax we are calculating in the for the year, it will be settled in the same year. Okay. There will be no case of arrears or advance payment for the tax. And the company claim tax allowable depreciation on the cost of investment on the straight line basis over 10 years. Means as you have been seen in the previous question, we are calculating the tax as per the WDV method, but here we have to calculate a tax relief on the basis of straight line basis which has been allowed by the tax authority. So DEGNIS company valued investment project using an after tax discount rate of 11%. So this is our cost of capital, or you can say the discount factor which we have to use in order to calculate the NPV. So there is no any inflation. So okay, now revenue, simply multiply sales unit into the selling price per unit. Okay. After that, contribution cost. Okay, also multiply production unit into the conversion cost per unit. So now, oh, contribution is conversion. It's my fault. Conversion. Less fixed cost 4,000, and we will get after that taxable cash flow. Okay, so we have to add these two amount. Okay, now less tax, and tax rate as per the question is 28%, right? Okay, so let's do it. After that we will get tax relief. It is quite simple here, you don't need to do separate calculation for the tax relief, as question has told the tax authority allow tax to be calculated on the basis of straight line. So just take the initial amount, which in our case is 4,000, and divide it by 10 because the life of it is 10 years, and multiply it with a tax rate which in our case is 28%, and it will be the same over the period, there will be no changes. Then net cash flow okay. ओहो यहाँ पे 500 हो गया, 5,000 है. ओके. ठीक है. Now we have to calculate expected NPV, right? So take the initial investment. Oh, I forgot to keep the initial investment. Initial investment, which in our case is 4,000. Okay, so take the initial investment, but be sure it should be in negative. Then NPV bracket, then our cost of capital, which in our case is 11%, and then undiscounted cash flow over the period. Okay, so now the project NPV is negative, so project is not financially acceptable, right? Or in you can say the planned investment NPV is negative, but it is not acceptable. Question haven't asked to comment let's see the next requirement. After the fourth year of operation, DEGNIS company expect to continue to produce and sell 450 motor homes per year for the foreseeable future. It means now company is planning to extend its operation period for the foreseeable future. Means यहाँ पे foreseeable future लिख लेते हैं, foreseeable future, and sales unit and production unit will be same as the fourth year of operation, that is 450. Okay. After the fourth year of operation, DEGNIS company expect to continue to produce and sell 450 motor homes per year for the foreseeable future. Okay. So calculate the effect on the expected NPV of the planned investment of the continuing to produce and sales motor homes beyond the first 4 years and comment on the financial acceptability of the planned investment. So now question has told to comment in the second part, not in the first part. So let's see. Our selling price will be same. Conversion cost will be same. Then fixed cost will be same. And so will be our revenue, conversion cost, contributions, fixed cost, okay, and taxable cash flow and tax amount. The only difference will be here we won't take the tax relief, because tax relief we will get only for the 10 years as per the tax authority. After that we won't get it. So but we are continuing this investment in the foreseeable future, that's why we won't consider tax relief here. We will do separate calculation for the tax relief. For now our net cash flow will be what is it, 2017.8. okay, so here net cash flow after 4 years without tax relief. Okay. Okay, so now as this production will continue for the foreseeable future, this will be the case of the perpetuity. And how do we get the present value in that case? We will simply take cash flow and divide it by the cost of capital, which in our case is 11%, right? So now this present value is for the at the start of the 5 years. Okay, so PV of 5 years. Now we have to multiply this present value of 5 years with the discount factor at the rate of 11% for the 4 years in order to get the present value of today, means T0. So PV of T0 means for today. Take this and multiply with the discount factor by looking at the chart. Discount factor for the 11% for the 4 year is 0.659. okay, so this is the present value for the T0. Okay, so now in this present value we will add tax relief which we get for the next 6 years, and it will be same as we have seen earlier. It will be 112, and it will be in the constant amount for the next 6 years. That's why we will apply the annuity factor for at the rate of 11%. Sorry, 11% for the 6th year. Okay, so 4.231, and we will get the present value for the same like the above at the for the 5 years. Now we will apply discount factor for the 4 years with same cost of capital which is 0.659. okay, and we will add these two amount. this will be the present value of the project if it will continue after the 4 years. Okay, so what if we will add this present value with this PV? एक सेकेंड हाँ. So okay, so now we do have the positive NPV. Okay, if the operation will continue in the foreseeable future, and if it will continue for the foreseeable, we do have a negative NPV. But as we consider on the whole, we will get the positive NPV, so which will change our decision. Earlier the project was not acceptable because NPV of the investment was negative. Due to that, project was not acceptable. But after we consider for the further year, for the foreseeable future, the NPV of the project becomes a negative. Now the project or investment is financially acceptable. Okay, so this thing you have to write in the comment. Next is the theoretical part, so I must suggest you guys to read the book, because मैं बोलूँगी वो फर्क नहीं पड़ेगा until and unless जब तक आप खुद पढ़ो एंड लिखो तब तक कुछ नहीं होने वाला. But मैं इतना हेल्प कर सकती हूँ. If you feel doubt like how to write and how to like if you are still having confusion, आपने जो लिखा है उस पर you can show it to me. Link I mean telegram का दिया हुआ description box में, you can send me there. I will try to help you how to improve in those answer. But मैं ये suggest करूँगी book पढ़ो and try to write it by yourself. Okay. Okay, so in next video we will do Harrison company question. So तब तक के लिए stay tuned with my channel. Bye bye.